Do you buy into that narrative that we are going to see policy easing, whether it's the monetary side of things, even as early as today, or the regulatory side of things? Of course, this GTV chart on the Bloomberg showing you how those easing speculation rumors actually led to property stocks rallying.
Yeah, no, we are buying that particular narrative. Actually, we bought into that narrative, I think it was October last year, when sentiment on China was really bad. People were saying it's not an investable market anymore. Most funds were significantly underweight. We said we think actually that some stimulus is going to come through probably by the end of this, that year, 2021 it was, and into 2022. So we moved overweight China at that particular point in time. And we see that now developing. You see actually that some stimulus is coming through on the monetary side. We've seen a rate cut. We see some stimulus on the fiscal side taking place. Valuations are still low. And what you also see is that mutual funds who were significantly underweight on Chinese equities in October, November this year, starting to rebuild positions there. So we see that they're still underweight, but not as much underweight anymore. And I think they can buy more, and that would support the market to a certain extent as well.
Will Chinese policymakers' actions shield the markets there from, say, the volatility that we could see, given that the U.S. is going the other direction?
Well, not completely. I mean, the correlation, the sensitivity, you could say, of in particular the mainland Chinese markets with the US market is not very high. So if the US market goes down, Chinese markets could go well up. But we cannot ignore, of course, that if the largest stock market in the world is having a bit of a tough start of the year, other markets will get dragged into that. So on a near-term basis, I think that will be a bit of an overhang for emerging markets in general as well. But eventually, I think we've already seen a large sell-off in particular Chinese equities last year. The valuation story is much lower. The interest rate story is quite different. In the US, interest rates are going up. In China, they're going down. In the rest of Asia, it's for the moment a kind of a hold. And maybe later on in the year, these rates need to go higher there up as well. But the dynamics are very different. So in the near term, if the US struggles overnight, Asian stocks might struggle a bit as well. But I think as we go deeper into 2022, we're going to see a differentiation there. And Chinese equities could actually turn out to be the exciting stuff of this year of the tiger.
The year of the tiger. What happens then to those rotation flows from Chinese equities? As you pointed out, last year they headed straight for India. You're saying that ASEAN was kind of largely ignored. Is this another start to the year where we see more optimistic outlooks when it comes to EMs in Southeast Asia?
Yeah, I think you're absolutely right. So we saw last year people wanted to get out of China. Internet was really poor. The property sector was really poor. And they moved into India for good reasons. India is large, liquid, and has got very little to do with China in the sense that the correlation is very low. So that's exactly where they went. And then in the beginning of the year, or late last year, to be honest, we started to see that reverse. Money started to flow back to China, as I mentioned earlier on as well. But some of them actually went to ASEAN as well. And I think there are very good reasons for it, because normally in these kind of periods when the US is expected to raise interest rates, the dollar is strong, certain currencies like the rupiah, the Indonesian rupiah, would be weak. And in the past, that would mean that the central bank, they had to raise interest rates in order to defend its currency, to make sure it wasn't too weak. And that was sometimes kind of, very unnecessary for domestic demand. I mean, domestic demand was already weak, and then they had to deal with higher interest rates as well. So the Indonesian economy would therefore struggle with that. Now it's almost the reverse. There is money going into places like Indonesia for the very simple reason that the place is chock full of nickel. People need it. So battery makers need to be there. So they go there. So you see investments going in, supports the currency. Inflation is low. They don't need to raise interest rates. The growth picture is better. Indonesia is the second or third fastest growing market this year in terms of earnings growth. So you got a very different story unfolding in ASEAN. And I think people need to be very cognizant of that. And I think Indonesia is one of the markets we are most excited about, actually, together with China this year.
What about the pressure coming from a more aggressive Fed, though? Bank of Indonesia has said they don't feel like they need to move in lockstep. When you take a look at currency carry and some of the bond spread buffers, it perhaps paints a pretty different picture of how much pressure there might be.
Yeah, no, there's a couple of risks to Asian equities that we should not ignore. One is that we see a more aggressive Fed than what currently is being priced in. The market says we're going to see about, say, 3 rate hikes this year, probably another 1 or 2 next year. If we see that the inflation picture remains very stubborn or it doesn't really come down, we might have to say, oh, they're going to do much more. That will be a negative. On the other hand, you could also say what could possibly go right for emerging markets this year, because it might also be that as we go deeper into the year, say by June, July, we find that some of the supply chains have eased a little bit. The inflationary pressure is still there, but maybe not as much. And suddenly we go into the opposite side and say, hey, maybe we don't need 3 rate hikes anymore. Maybe we're happy with 2. And suddenly then you have the reverse picture emerging. And that could actually be quite positive for your emerging markets. So an aggressive Fed is a risk. But maybe also what could possibly go right, a not aggressive Fed could also turn out to be a risk. And maybe these bond yields, which you guys were talking about this morning, I think, stubbornly being over 1.8% on the 10-year in the US, what if they would start to sink a little bit lower again? We've seen this about a year ago happening as well. So that could be an opposite risk for a positive risk for emerging market or Asian equities in general.